Nice to speak to entrepreneurs. I've spoken to a few of you through Civitas, and I'm always very inspired by what you guys are up to. And yeah, so I'm Irish, which is why I have this bizarre first name, but I'm married to a South African. And in today's parlance, I guess you could say I identify as South African. Although I'm in Mauritius now, I spent 12 years in Joburg up until the end of 2018. I'm an international tax specialist and a structuring specialist particularly. So I started my career at Arthur Andersen in London. Some of you are probably too young to remember Arthur Andersen. And then when I moved to Joburg, I was at Sasol. I was the head of international tax there. So my whole career has been international tax, specifically with corporates focusing on how to structure to optimize their operations. And when we talk about structure, we're really talking about how to manipulate and put in place different entities in different jurisdictions to improve the overall group position. Obviously, firstly, from a tax perspective, and that's from a tax perspective all the way through to shareholders, especially when we've got owner-managed businesses like most of you would have. Second of all, in the South African context, SARB is a big issue, so you want to look at optimizing your structure to minimize the hassle you have with SARB. And thirdly, but I think most importantly in the African context, it's to minimize your exposure to volatile currencies. So if you're working with not only South African clients, it is worth looking at your structure and particularly globalizing or externalizing your structure from South Africa to firstly ensure you can work as much as possible in hard currency and retain hard currency. Second of all, minimize restrictions with from SARB. And third of all, reduce your holistic tax charges. So that's basically in a nutshell what we focus on at Regan van Roy. Our main office is in South Africa. We have one in Joburg and one in Cape Town. And I head up the Mauritius tax office, and then we have a small office in Ireland as well.
Awesome. Yeah, so I think maybe to kick off, is the first thing is when would be the right time to start looking at actually setting up an international structure?
Yeah, and my advice for startups is always rather err on the side of going a bit late. I've spoken to a lot of people who are startups, either via Civitas or other groups. And my usual response is, don't look at it now. If you set up the wrong structure, it's worse than not setting up any structure at all. It's complex to unwind and it's expensive to run. And if it is not done properly, all you've done is spent money without getting any benefit. So I just want to say that again. Setting up the wrong structure is way worse than not setting up any external structure at all. So do make sure you don't set it up too soon. That is generally the biggest problem I see with startups. And generally my advice would be wait until you have a strong pipeline of overseas clients. And that, you know, how strong a pipeline depends on the size of your business. But wait until you have what for you is a sizable pipeline of non-South African work, and then look at structure, ideally before you sign long-term contracts.
So is that, just to clarify, is that you wouldn't want to actually land a couple of international clients and then set up the structure? Ideally what you would want is as the first deal, or I'd imagine it would also depend on the ticket size of your product.
Yeah, maybe let's just talk about why I say it's worse to set up a wrong structure than just structure a little bit too late or not structure at all. If you set up a structure too soon, it is expensive. I mean, everyone always if you speak to a management company, they always say, oh yeah, it's very, very easy and quick to set up a company overseas. I would recommend, especially small businesses like yourselves, treat setting up a company, particularly in a new jurisdiction, treat it like getting married or having a baby. It's something that is very quick to do, cheap to do, but you live with it for a long time afterwards. So you need to think very, very carefully about it, particularly for small businesses who to date have only been in South Africa. because once you become an international group, you enter into a whole new world of complexity, risk, and additional cost. So the main, maybe we can just tap on the main concerns with a structure. Often, if people set up a structure too soon, they don't have the resources to man it sufficiently. And if let's say you set up an entity in Mauritius, but you don't have enough staff you don't have enough resources to be able to employ staff there, then that company will not be seen as tax resident in Mauritius. It will actually be seen as tax resident in South Africa. So all you will have done is incurred management time and costs in setting up something that has achieved no purpose. Even if you can ensure that it is not managed in South Africa, managed in Mauritius, so that it's resident in Mauritius, it could still fall foul of various anti-avoidance rules in South Africa, which are very complex and designed specifically to attack South African businesses trying to push profits offshore. It's very easy to fall foul of those unless you have enough resources to, essentially it's around building substance in an overseas country. So that's really why I say don't set up a structure too soon, because unless you have the time and resources, including overseas personnel, to ensure that it is set up correctly, then you will not be achieving what you want to achieve, and you will just have spent money for nothing. So in terms of when, obviously it depends per company, but generally I would say wait until you have a big client. Ideally, you've got one in the pipeline and then you set the company up so your new company can be the contracting entity. That's not always possible, and that would be ideal. But if not, you can enter into the initial contract from the South African company and then enter into subsequent contracts with the overseas company.
Cool. So I'm going to just jump down further down the list on questions. Is a common sort of, I've heard two different tacks of advice on setting up early. So I've met with someone who said you want to set up very early because the IP needs to sit offshore from the get-go. And then I've also heard that that's not an issue because you can just version your software and get the IP out it's not a major hassle to actually get the IP offshore. What's your view on sort of the timing of when you're setting stuff and then actually getting the IP offshore?
Yeah, so ideally, in contradiction to what I've said, it is better in an ideal world to set up soon. However, in a startup scenario where you have limited staff and limited funds, most startups will not have enough funds to staff the overseas entity correctly. So in order to, if you set up a company in, let's say in Mauritius, it costs, let's say $5,000 to set up. But in order for that company to remain tax resident in Mauritius, i.e. for SARS not to be able to claim that it is managed from South Africa and therefore tax resident in South Africa, you have to have senior staff in Mauritius. So unless the startup has enough staff and resources to be able to either appoint senior staff in Mauritius or to send some of their existing staff over, they will not be able to meet the substance requirements, which will mean that although they have set up the company, they have not been able to externalize their structure because they would have fallen within the anti-avoidance provisions from the South African side, which is essentially, if you have a foreign company that is managed from South Africa, then the foreign company is deemed to be tax resident in South Africa. Does that make sense?
Yes. Okay, cool.
So just to reiterate, definitely in theory, if your startup has got a blank checkbook and loads of staff, which no startup I've ever met has, then definitely it's better to start up. It's better to start sooner rather than later, particularly in terms of IP. But in the real world, where startups, we don't know what the likelihood of success is, when growth will happen, there's limited time, limited resources, management have got too much on their plates already, and to set up a new structure and a new entity offshore and try to run it successfully is often almost impossible to achieve.
Cool. Awesome, eh? So just around then I think you've spoken a little bit about the management cost of running local and international businesses. I don't know if there's anything you'd like to add there.
Yeah, maybe just to say, are you still there? You seem to have frozen.
No, I'm still here.
Okay, maybe just to say, if you're looking at structure, I would say the last person to talk to is a management company. Most problems arise when you go to a management company, and a management company...
Sorry, Caoilfhionn, can I just jump in? Do you mind just defining management company and what you do, just so everyone's sort of clear on it?
Yes. So a management company is a company that sets up companies and trusts and acts as director for you. So in a kind of tax favorable jurisdiction like Mauritius, Ireland, Delaware, South Africa, there's lots of them. If anyone has seen that movie Laundromat about the Panama Papers, Mossack Fonseca is a management company. So most people, most startups, when they set up a structure, they go to a management company, and the management company says, oh, you should set up an offshore company in Mauritius, and you should set up an offshore trust. I can do it for you, $10,000. Here we go, I'll be your directors. I would say the last person you go to is a management company. You first need to understand what you want to achieve from a tax and exchange control and general structuring perspective. And only when you have that clear do you instruct the management company to set it up.
Cool, awesome. So the next one then is what common countries do you see? And then what are sort of the rules and heuristics around how do you choose where you should be setting up? And what are some of the sort of things that you should be considering around, should it be here, Ireland, Estonia, Delaware?
Yeah, and this is also why it's important not to set up too soon, because where you set up will depend on a number of factors, but probably mainly where you expect your clients to be. So if you expect your clients to be mainly in the US, often a jurisdiction that works well would be Ireland or a Delaware LLP, although that's a different beast. If you expect most of your business to be in Africa, Mauritius is a common jurisdiction. If you expect most of your business to be in Europe, Ireland, the Netherlands, Luxembourg are common. Asia, Singapore would be the common one. And the reasons why all of those are the kind of likely culprits in those areas is because they've all set themselves up as offshore jurisdictions, which is the new PC term for tax havens. And essentially they have a tax regime that is supportive of investment holdings. So typically each of those countries would have a very good network of tax treaties. So that's a treaty that's in place between two countries that avoids double tax and gives some reliefs. So for instance, Mauritius has an excellent network of treaties for Africa. So any holding company location or offshore company has to have a good treaty network. It also has low tax in country, usually also for employees, not always. I mean, Ireland is an example of a good country, of a country that's got a low corporate tax regime, but a high personal tax regime, whereas Singapore and Mauritius generally have both low corporate and low personal. And then it generally should be a holding company that allows, that's easy from a banking perspective, that allows you to work in whatever currency you want, that doesn't have exchange control, that has beneficial tax regimes for the treatment of dividends, interest, and royalties. And then in terms of what specific jurisdiction makes sense for each person or for each group, depends, as I say, primarily on where the customers are located, but also on things like language, time zone, geographical location, because generally the directors would be from the head office company and would have to fly there regularly for board meetings.
Okay, great. So Ant, I see you put your hand raised. Do you want to jump in?
Yeah, hi. Can you hear me?
Yes.
Good. How's it, Caoilfhionn? How are you doing?
Hi, Ant. Good. How are you?
Good, thanks. So I've got a question, and just for to put this in context, Caoilfhionn, I set up my structure about 2 years ago, and you very firmly advised me I was going too soon. I can testify that it's a very expensive exercise. but I did it for exchange control purposes because I wanted to register. I wanted to avoid being in a loop structure before I became a permanent resident of South Africa. And I just wanted to understand, I know there's changes that are being, lots of changes in the international tax jurisdictions, and GBLs and GBCs, or whatever they're called, are becoming less and less effective in their in their tax mitigation roles. But could you just outline firstly the difference between being tax resident and being exchange control non-resident, if you like, tax non-resident and exchange control non-resident, and what the current changes that have been going on in relation to the Mauritius domicile mean for people who already have structures?
Yeah, and that's a good question. So there's three types of residence for an individual. There's only one type of residence really for a company. So for an individual, there's your right to live somewhere, which is linked to your passport and your work permit. There's your tax residency, which is linked to where you live and work and are seen to have your habitual abode. So for everyone who's living in Johannesburg, unless they're not South African and haven't been there for more than 6 years, you would all be resident in tax resident in South Africa. Exchange controlled residence is different again, and it basically applies to any permanent resident of South Africa. So anyone who is a South African citizen or becomes a South African permanent resident automatically becomes a SARB resident. And when you emigrate from South Africa, you can choose whether you want to emigrate for tax purposes or exchange control purposes or both. Generally, it is beneficial to emigrate for tax purposes, and it's relatively straightforward. It takes quite a lot of time to emigrate from an exchange control perspective, and it is not always needed. And so, for instance, when I moved to Mauritius myself, I didn't emigrate from an exchange control perspective. Neither did my husband, because you're still entitled to take out 10 million rand per person per year. So you generally would only need to emigrate from an exchange control perspective if you have hundreds of millions of rand in South Africa that you want to take out regularly. The company residence is basically where the company is managed. For all types of residence, every country has their own rules and regulations, but they're kind of broadly the same. And the tax residence definition for a company is that a company is deemed to be resident where its place of effective management is. So that was the concern about, even if you set up a company in Mauritius, but the only person who runs it or applies their mind to it or knows anything about the business is in South Africa, then it clearly is actually managed from South Africa rather than Mauritius. And the problem is, if the company is deemed to be tax resident in South Africa, it's then required to set up a branch in South Africa, which then in turn becomes a South African SARB resident. So that's an example of what I meant by people setting up structures too soon, and they think they're achieving a benefit, but if they don't have the resources to be able to support the substance that is required overseas, they basically end up with a situation where they have, they're back to square one. They have a South African branch rather than a company, but which is exchange control resident, and often then the IP ends up back in South Africa.
So just to add then, Caoilfhionn, one thing in relation to the IP then, if one registers trademarks in a Mauritius domiciled company or offshore company, if you registered those trademarks in South Africa in the name of that offshore company, is that an effective use of that structure? Or do you think it's not really necessary?
Well, it all comes down to the substance of the structure, really. So you can do whatever you want in the legal entity, but if the legal entity is seen as a South African and a SARB tax resident, it doesn't matter where legally the issues sit. And then it comes down to transfer pricing. transfer pricing is the rule that says you must apply arm's length terms on transactions between connected persons. So your branch in South Africa must then be regarded as a separate person, and based on what happens in South Africa versus what happens in Mauritius, the value of the IP is allocated. And typically in a startup scenario, nothing will happen overseas. So if it's challenged, it's very difficult to justify anything accruing in the offshore jurisdiction. And to answer the second part of your question, there has been in February a complete overhaul of the SA exchange control system was announced, and nobody knows what it's going to look like. But so it does mean that at the moment it's very hard to get any confirmation of anything from the Reserve Bank, because even they don't know what's going to happen. And all we can say is that likely this time next year, the Reserve Bank regime will look very different. Up until probably last year, we were expecting it to be relaxed and more, but some of the changes we've seen recently, in particular the proposal that if you emigrate from South Africa for tax purposes, you cannot withdraw your retirement annuity for 3 years. So some of the proposals we've seen actually are concerning us a little bit, that SARB might tighten up further.
Oh, okay. And anything else, or are you happy there?
All good. Thanks, Paul.
Well, great. Awesome. Cool. So then, Caoilfhionn, if you're going to you decided to go ahead with someone, how would you assess, or where would you start looking if to basically find someone to help you walk this journey to getting it all set up? And how would you assess if they're any good?
Yeah, another good question. So again, my advice would be, do not start with a management company. The management company's game is their whole business is to set up as many companies and trusts for you as possible, and to have as many non-resident directors for you as possible. That is their business. So they're inherently compromised by what they're proposing to you. And also they're not tax experts or structuring experts, and they don't profess to be. They're kind of corporate directors for hire and experts on specific company law regimes. So I would say first start with a tax advisor, and ideally also you need input on the SARB issues, and depending on your personal situation, it could also be worthwhile looking at your own wealth planning, particularly from the estate perspective, because often when you set up an overseas company, on day one it's worth zero. And that's a good time to think about, for instance, the shares being owned by a trust of which your children are beneficiaries, or the shares being owned for your children in a way to get it out of your estate. So my first suggestion would be, don't start with management companies, start with someone who can advise you on the tax and broader structuring requirements. My second advice would be, treat it as seriously as you would treat deciding on a surgeon who's going to, give you open heart surgery. So speak to a few people, sound them out, ask them questions, ask them, explain your business, say to them, what do you think I should do? What risks do you think I should be mitigating against? What benefits do you think I could achieve? And kind of put them through their paces a little bit. Also, beware of anyone who doesn't really want to understand your business. Which means beware of people who are just trying to sell you something. Either, they want to sell you a trust structure, or they want to sell you a kind of one-size-fits-all approach. You want someone who really takes time to sit with you and understand what you're trying to achieve, and long-term. Because the thing about structure, it is very expensive to do right. It is more expensive to do wrong. So you need to make sure that you do it right up front, but invest the time and the money and the understanding with the right person. And you want a structure that will last long term. Depending on how quickly your business moves, it could be only 5 years, but it could be 15 years if your structure, if your business isn't going to change massively. But you do not want to have to change a structure regularly, because it's expensive, and it results in tax costs when you move entities or have shift ownership. and it also takes a lot of time. So that means don't rely on any kind of current loopholes. If people are trying to sell you a structure that's based on a specific technicality that is likely to be changed in a couple of years, don't do it, because it will cost you more in terms of consulting fees, tax costs, and time in the long term. But overall, my advice is take time to speak to a couple of different people, get ideas from them, and then use what you've learned to kind of interact with the next person until you find someone you're comfortable with, until you find someone who you think has got the same ethos as you in terms of what's important for a structure, what's important for my business, and ensure that you understand what they tell you right from the beginning. Do not be afraid to ask questions. Part of what you're paying for is for you to understand it deeply. I mean, most of you guys won't be financial people, and so don't be afraid to dig in and say, hold on, I don't understand what that means. What do you mean by a preference share, or how will that work? So I would say that's find someone you're comfortable with, who you trust. Don't go with anything that sounds like a kind of cut and paste or an off-the-shelf option. Don't go with something that relies on a kind of short-termist interpretation that's likely to change, and make sure you understand it every step of the way.
Cool, awesome, thanks. So Rihanna, I don't know, you had a question. Do you want to maybe jump in there?
Yeah, thanks, Paul. Thanks, Caoilfhionn. Very new to the area, and it's a very interesting topic that you're discussing. I just had a question here. So, considering if you've got new clients overseas or so, what revenue volume outside South Africa, is there a specific turnover amount that can be used as a benchmark that would warrant the expense of getting a structure set up? And because sometimes there's a sweet spot that could be found between incurring the cost in South Africa as opposed to incurring the cost of setting up the structure.
Yeah, that's a good question. I often joke that my most common answer is it depends, and really it depends on the business. So I think the best way to answer it maybe is that to set up a new company and do all of the kind of offshore costs you need to cover, like offshore directors, you should budget on at least $12,000 a year. And that's to get the structure planning to act. So that's the kind of actual set up your company, appoint the directors, get the licenses you need, $12,000 a year at least. So that's a lot of money already. In terms of getting the advice to know how to set it up, you're talking close to that amount already, to be honest. So any offshore customer you need to see in that context. If you've got an offshore client who's going to be R1 million, and you know that if you run it via an offshore company, you will be able to pay much less tax on it than in South Africa, then you can consider it against the, let's say, $20,000 or $24,000. But just remember that when you set up a company, it's easy. I mean, it's relatively cheap to set up. Management companies will say, oh yeah, $5,000. But then it's the additional fees that come on top of that, the directors. And don't forget, it's every single year. You have to have audited accounts, you have to have company secretarial submissions. So that's why, especially with startups, and I mean, if we were doing this presentation with multinationals, I wouldn't even be mentioning this, but especially with startups where you've got limited resources, you've got a small number of senior management who really want to spend time on building the business, not on trying to figure out, how are we going to staff this new entity in Singapore. I would really say, rather err on the side of caution. And until you believe that there is a meaningful long-term pipeline of clients, and that the structure can operate in such a way that you can justify that revenue being earned by the offshore company. I mean, it's not enough just to set up the offshore company, route the contract through it, but everything happens in South Africa, because transfer pricing would dictate that then most of it has to be taxed in South Africa. But so long as, depending on the nature of the service, you would be able to set up a structure where a good slice of that revenue sits in the offshore company, then you compare it against your $12,000 per annum, in infinity. Obviously, if you wind it down, there's still significant wind-up costs, plus your additional initial setup costs in terms of tax advice and the actual physical setup, and then you decide whether it's worthwhile.
Thank you.
Sorry, that was a bit of a non-answer, but I hope it makes sense.
Cool. Awesome. Dean, do you want to jump in? You've got 2 questions there, so why don't you fire away?
Cool. So I just wanted to ask just around, financial immigration. Right? I think it's something that, a lot of business owners are now sort of having to consider. If you're going to immigrate to another country and you have local businesses, what are some of the implications of financial immigration? And what would your advice be in terms of the actual shareholding, to someone who is considering that?
Yeah, so Dean, first of all, I don't use the term financial immigration because people get confused with it. There's tax immigration and there's exchange control immigration. Usually financial immigration is used to mean exchange control immigration. But let's talk about the two. As we said before, it almost always, if you're actually leaving the country, it almost always makes sense to emigrate from a tax perspective, particularly given the changes to the 1010 regime. So the rules used to be in South Africa, similar to in most developed countries, whereby if you were a South African resident, but you were spending most of your time overseas and earned a salary overseas, South Africa wouldn't tax you on it. Now, from March this year, that has changed. And now, even if you're living overseas and you don't go back to South Africa, but you have never formally emigrated, you would still have to pay tax on your overseas salary above 1.25 million. So almost always it makes sense to tax emigrate. Because in any event, you will become tax resident in the country that you live in next. And either you'll pay double tax and have to claim relief, or likely you'll be moving to a country with a lower tax rate and then you don't want to be paying the extra South African tax. So almost always makes sense to tax emigrate. And usually it doesn't make sense to, or usually it's a bit of it's more hassle than it's worth to emigrate from a SARB perspective, because you only really need to do it if you've got masses of money in South Africa that you need to take out, i.e. that you've got more than 10 million rand per annum that you want to take out of the country, because you cannot do that simply as a SARB resident. And if you emigrate, there's no problem from a tax perspective with owning shares in South Africa. In fact, you would be better off because as a South African resident, you suffer 20% withholding tax on dividends from your South African company. But if you live overseas, you will suffer a lower withholding tax rate depending on the country you live in and depending on the double taxation agreement in place with that country. But it's basically from 0 to 10% usually. So that is, that's probably a main benefit of, so that would happen on the tax perspective for the shares. On the exchange control perspective with holding shares, all you would need to do is to get your bank to stamp the shares as non-resident, which means then that when a dividend arises, they can be paid offshore.
And if you sort of hold those shares through a trust and holding company structure and you tax immigrate overseas, but your trust is in South Africa, you're holding companies in South Africa, what does that look like?
Yeah, so I mean, there's no simple answer to that because it depends on what the structure is. But essentially, it's very simple to hold shares from overseas into South Africa. And generally, there would be no tax. There would be no tax on receipt, provided you own more than 25%, because it would generally fall within a participation exemption, which most countries have. Generally, you would have a lower withholding tax than you would have had you remained South African resident. Trusts are more complicated, because as you know, SARS views trusts as tax avoidance strategies. So there's a lot of very complicated anti-avoidance rules around trusts, a lot of which change every year, which is why when you're looking at a long-term structure, you should be careful about trusts because the rules change very quickly and very often. So you can often you have to end up unwinding them. But so it would depend if it's a South African trust And it would be different to it's an international trust. It depends if it's a vested or beneficiary trust. You might need to get rid of the trust, and probably the simplest way would be to hold your shares directly from overseas into your SA co.
Okay, thank you.
Awesome. Ryan, do you want to jump in there?
Yeah, thanks, Keelan. This is really informative. So we've got a number of members who are citizens. They've got dual citizenship in a number of different countries, and they're sort of seeing that as, you know, an easier approach to set up an international entity. Do the conditions change at all, or you know, options to consider?
Yeah, so it basically doesn't matter if you're a citizen of somewhere else. As we said, there's 3 types of residence. The one is the right to abode, which is great. It means you can go and live anywhere, but it doesn't impact your tax residence. So for instance, I had to tax emigrate from South Africa. Although I'm Irish, I wasn't even a permanent resident in South Africa, in exactly the same way that my husband, who's from the Free State, had to emigrate. So the issue is, are you a South African tax resident or not? And as a simple rule, if you've lived in South Africa for 6 years, you're going to be a South African tax resident. Even if you lived there for less, but you know, that's clearly your main home, and there's a lot of case law around your centre of vital interest, and you could also be seen to be tax resident there. But I think the simple rule is, if you've been there if you're in your 6th year of living there, you're a South African tax resident, and then you still need to emigrate. The difficulty with emigration is, and luckily this, well, I was going to say it's not always a problem for startups, but often actually it is. The difficulty is that you have to pay an exit charge. So when you emigrate for tax purposes, you sever the taxation relationship with South Africa, which, as we've said, is generally beneficial because South Africa is a high tax jurisdiction. And if you move to another high tax jurisdiction, you just pay double tax. If you move to a low tax jurisdiction, then there's no reason to pay your South African tax. But to sever your tax relationship with South Africa, you have to pay an exit charge, which means on the day you emigrate, you are deemed to have disposed of all of your assets at market value, and then you pay a capital gain on the growth. So for people who have successful businesses in South Africa that you've got shares in, there's generally an increase in value there. You would have to get an external valuation and pay tax on that increase in value. You don't have to pay tax on South African real estate, so property or real estate rich companies, or on personal assets like your gold glasses. You wouldn't have to pay CGT on those, or your cars or jewelry or stuff like that. But the main areas where we'd see cost are on shares and on share portfolios.
Thank you.
Keelan, can I just ask a follow-up question on that? Just in terms of like the tax immigration. So in that case, in terms of the capital gains tax on your shares, am I right in saying that if you actually don't own the shares in your personal capacity and you actually do own them through a trust, effectively the trust owns your shares through a holding company, would you then avoid that whole capital gains tax event on your businesses?
Again, that's a very complicated question. It depends on the rules of the trust, and there can also be a capital gain on the trust. So it depends on who the beneficiaries are, what type of a trust is it, how the shares are held, how long they've been held there, how it's been funded. So the answer could be you avoid tax, but it also may not be. Because the issue is, in your instance, is it a South African trust or an international trust?
It's a South African trust that's owned by, it owns a holding company, and the holding company owns the equity in underlying companies in South Africa. And it's been set up like that from day one.
And yeah, the difficulty is you'd probably have to unwind the South African trust, and that will give rise to CGT.
Why would I have to unwind the trust? Can't I continue with the trust as is?
Yes, you could, but it probably wouldn't be beneficial if you emigrate to work through a South African trust, because then you would be subject to South African tax in the trust level. But trusts are trusts are a whole different beast, and as you know, there's many different forms of trusts. So I can't.
Yeah, sorry. If the intention is not to realize the dividends and stuff at a trust level, but rather have it from an ownership and I guess an estate planning perspective. You're not
So
come back into the trust.
So the main problem with retaining the shares in the South African trust, or a main problem, is that then you will suffer 20% withholding tax. Whereas if you were to hold the shares directly in your name when you go overseas, you should be able to structure it so that it's 0%. So typically, it doesn't make sense if you emigrate to maintain a South African trust. And typically, the unwind of the South African trust gives rise to essentially the same capital gain as on the exit charge, because it relates to the same assets, albeit that they're wrapped in a trust. But it is a complicated question.
Okay, thanks.
Awesome, eh? So then, Caoilfhionn, as a last question, or wrapping up, is that if people are interested in going international and that's on their roadmap, how would you suggest that they go about upskilling themselves on sort of this area of where to go and how to set it all up? And should they rather just wait until they get enough cash and speak to an expert, or is there something they should be doing on the side to sort of get ready to go offshore?
I would say, again, my number one piece of advice, and don't quote me on this, is don't talk to a management company, because they will just try and sell you structures. And I do think it is worthwhile understanding what the issues are. And I think I mentioned to you, Paul, when we first spoke, since I've moved to Mauritius, it's become a bit of a personal passion of mine to help small South African businesses who have never gone outside of South Africa. Because since we moved here, I have seen so many of them who have set up structures because they went to, a big management company and got an opinion that, oh, if you set up this company, your IP will be out of South Africa, and it's $4,000 to set up. By the way, we'll charge you $12,000 every year, and here's the way the contracts will work. And based on that opinion, they set up a structure that has no benefit, because it doesn't work in terms of the South African anti-avoidance rules. So I've actually done a couple of trainings for specifically for South African groups who are looking to expand and to understand what the key risks are. And just in a nutshell, the key risk is if you set up an offshore entity, but you have nothing to do with it, nothing happens in it, it's not going to work. And I think it is worth upskilling yourself on understanding how the South African regulations work, so that you can understand at what stage of your business is this type of approach going to be feasible.
So 2 questions there is, one, do you do those workshops regularly? And if so, can we be notified when you're doing this next one? And the second question, where else could you actually go to sort of read up or learn a little bit about this type of information?
Let me think. The problem with this stuff is it's so complex that it's hard to find a sort of layman's guide to it that has enough information to actually be meaningful, but that won't put you straight to sleep. So let me give it some thought. I'm happy to share the slides. I mean, I'm happy to give a presentation to you guys on it. We don't do paid training, but Paul, we can speak about it separately, but I'd be happy to offer that to you guys. Otherwise, I remember I did a program a few years ago called Tax for Non-Tax People. And it was basically explaining, it was actually more geared at CEOs of corporates who are not financial people to understand the key issues of international tax. So let me think about, is there any reading I could direct you to? I mean, there's often good newsletters knocking about, but the problem is it's such a deep field that it's hard to find something that's relevant to what you guys need.
Okay, great. So Caoilfhionn, if someone is interested in engaging in your services, I think it would be helpful maybe if you could just give where they're too early and sort of minimum budget to sort of engage. They know that, okay, cool, and maybe some hourly rate. So you're not going to get some time wasters, but then they know sort of, okay, cool, this is what I'm looking at. So some idea around that. And then also if they do want to get hold of you, you're more than welcome to sort of share how they could do that.
Yeah, so as I said at the beginning, when I've spoken to people through Civitas, most of the time I've just said to guys, it's too soon, don't bother. So I would say, think about is a $12,000 one-off plus $12,000 per annum investment in setting up an international structure. Is that something that makes sense given the size of my international business or pipeline at this time? And only if it is, and it should be, you know, your international pipeline should be like multiples time bigger than that, then it is worth having a discussion. It is definitely worth discussing if one of the people in your group is already planning to move overseas, because as I've said, the main problem with setting up overseas is if there's no substance in it, and substance at the end of the day comes down to human beings. So if you don't have a senior person over there, you cannot justify that anything happens there. So I would say if you've got someone in the organization who's already planning to move overseas, it's definitely worth having a discussion. In terms of our fees, you know, for kind of $10,000 would be our kind of general price to look at setting up a holistic structure, less for a startup. And we do have special rates for South African clients. So that's what we charge in Mauritius. But I mean, typically kind of 100,000 Rand is the ballpark to identify a full structure that will work for your global business, including revenues back to shareholder. And that covers, you know, everything that you need to look at from a company setup, what transactions flow, how to optimize the tax on them, how to optimize the forex and the withholding tax on the transfer pricing. It would cover you know, all of those factors. So it's definitely not a cheap exercise, and that's also why my most common advice to small businesses is rather structure a little bit too late than a little bit early, because first of all, it's a good chunk of money, but it's also a good chunk of time, because if the senior people in the business do not understand and are not part of the structuring process, it's a waste of time. It's just going to be a report on the shelf, or, you know, they'll set up companies but won't follow the procedures that have been agreed, and it will flop. So, you know, so that's why I think it's rather go a little bit late. And the two issues to look out for is whether someone is moving overseas, and if you have a growing pipeline of international work.
Awesome. Caoilfhionn, that was brilliant. Thanks so much. I think it's cleared a lot of the sort of just murkiness around, hey, I'm wanting to do this international thing. When should I do it? So I think there were some really simple and straightforward answers. So really, really do appreciate it. And we'll be in touch. Hey, really, thanks so much for your time.
Great. Okay, you're very welcome. Nice to speak to you.
Great. Have a lovely day.